Hey guys, Ali here. Welcome to my channel Solid Trades. So today's video is very important for beginner traders or for intermediate traders who are not consistently profitable, because I'm sure there are some things that they are missing from their daily routine, or there's some rules that they're not following, and this could be one of them. So stick to it to the end of the video. I think this could be now, just like if you open a restaurant business, you need to make sure that you have tables, chairs, cutleries available for your customers, right? When they come in and dine in. Similarly, there are some rules in day trading that you must do. There are things that you must do in order to be successful in day trading business, all right? And those are the rules, those are the things that I'm going to be discussing today. So I think if you're not doing any one of them, it's highly unlikely that you're going to be consistently profitable. Now, I say consistently profitable. Everybody can make money in the stock market. We all know that. Any inexperienced or experienced person can make money, but I'm talking about consistently making money so that you can do it long term. Okay, so let's get into it. So number one is have a trade plan. Whenever now obviously not before, but when I actually started becoming profitable, the number one thing I started doing was to wake up early before the market opened, and I did my homework. I made sure that what stocks I'm going to be I'm going to be buying or selling or shorting, and what levels I'm going to be doing. So I'll be drawing my support resistance lines before the market opens. So when the market opens and it hit those levels, I know to buy at that point. I'm not making decisions right when things are happening. I've already made my decisions. If this happens, I'm going to do this. If this happens, I'm going to do this. So when it actually happens in the stock market in real time, I already have a plan. I'm already prepared. Okay? Because during the market hours, you only execute your plan that you made pre-market. And that what helps you basically to keep your emotions in check. You don't get very edgy, right? Because you already know what you're gonna do before it actually does. Okay, so this is something very important. It keeps your emotions in check, which is the number one thing that you need to do, right? Psychology. Keep your emotions in check, and that really helps you to keep your emotions in check, is to have a trade plan. Now the second is stocks in play. This is so important. You are only good as stocks you trade in. If the stock does not move, no matter how great you're a trader, it doesn't matter. You're not going to make money. Let's say if you buy 1,000 shares and it doesn't move anything, you're not going to make any money. But let's say if you buy 1,000 shares and the stock goes up $2, you're going to make $2,000. So you're only good as the stocks you trade in. Okay, so when I say the stocks as good the stock, it means the stocks that you're trading in has a catalyst, has a range. Catalyst means there's a good news on the stock, so it's most likely going to go up that day, or it has a range on a stock. Like for example, Tesla, it moves $10 to $20 a day, sometimes even $50 to $100 in a day, up or down. So there's a high chance of you making money, whereas the stock, if it's $100 and only moves like 20 cents, it's going to be really tough. Okay. Another thing that you can do to find the good stocks in place to have high relative volume than average days. For example, during average days, every other day the stock moves, stock has volume of 1 million shares, but that day it has over 5 million. It means more people are watching that day, so it means that day that stock's going to be in play. Okay, so now that you already have your plan, you already have your stocks that you're going to be trading in, the next thing is to execute your trade, and then also manage your risk. And the most important part of managing the risk is to stick to your stops. Never average down in your stock. If you think you're gonna get out at a particular price, get out if it doesn't go your way. Don't add more to your position when it goes against you. Okay, this is the most I cannot stress this enough. One of the most important parts is to not average down, which a lot of people do. Now some people will say, yeah, what if it comes back up? I agree that what if it comes back up? But what if it doesn't come back up? Let's say even 90% of the stocks that do come back up and you don't have to stop out. But what about those 10% of the stocks that when they go down, they keep going down and down and down and down and kill your whole account? That is why it's so important to stick to your stops and never average down. And in order to make sure that you stick to your stops, you first need to know your exits before entering a trade. Right? If you don't know what is going to be your exit before you enter a trade, what are you going to do when it actually goes down? You don't even know what to do. So you have to have your plan. It's a game of probability. Even if you're right only 50% of the time and wrong 50% of the time, and if you stick to your stop losses, you're going to end up making money because the law of probability will be on your side. For example, if you lose $100 every time when you're wrong and you make $200 every time you're right, even with the win rate of 50%, you will end up being profitable at the end of the day. And that is what you do. Your job as a trader is not to win every single time, but to make money consistently in the stock market. That's what matters. When you go to your bank to cash that money that you made in trading, the bank doesn't ask you, oh, how many times were you wrong? How many times were you right? What was your average win rate? What was your average losing rate? They don't ask you nothing. Okay, even if you're wrong 90% of the time, but still end up making money, you will get that money. So always remember that. Cut your ego on the side. And that's the main ingredient, is to always lose less, but when you win, you make more. Okay? For example, let's say that you buy a stock at this area and the stock starts to going up, you peel some profits, and then it comes back down. Starts to go back up again, but then it comes back down again, you get stopped out, which was your original stop entry price, and you avoid this huge loss. Next is position sizing and risk management. So important. So each trade should be same risk, not same shares. Example, if you're losing $100 per trade, okay, let's say that every single trade you take, you don't want to lose more than $100. So how would you trade? So if you buy a stock for $200 and the stop is $1, then you will buy 100 shares, equal to $100 loss. Because if it goes down $1, you will get out and you will only lose $100 because you bought 100 shares. Now, so many people make this mistake. So here, let's say that if you buy a stock for $200 and the stop is $2, then you're not going to buy 100 shares like you did before, because now your stop is a little bigger. Your stop is $2, so you're going to buy 50 shares. So if it goes against you, you're still going to lose $100. So many times people make this mistake where they buy 100 shares every single time, regardless what their stop is. So if their stop is $2, now they're going to lose $200. And that messes up with their psychology, messes up with their brain, and they end up making more mistakes. So important. Position sizing is so important. Make sure you do proper research in position sizing and risk management. This is so important. I cannot stress this enough. Now, the reason why is because each trade is independent. Now, what do I say by independent? If you make money in the previous trade, doesn't mean that you're going to make money in the next trade. So why do you buy 100 shares in the previous trade when you make money, and then you increase your size to 1,000 shares, for example, and then you lose money, so you lose all your profits and even more? That is why it's so important to keep your position sizing the same every single trade, right? Because each trade is independent and market doesn't care about you. So you have to manage your risk. Okay, so summary is to have always a trade plan, trade stocks in play so that you have a better chance of winning, always manage your risk with stop losses, and equal position sizing. All right, these are the 4 pillars. Now, there are lots of other rules that might apply to you, but these are the pillars that every single trader follow. If you don't do any of these, it's highly unlikely that you're going to make money consistently. Again, I repeat, consistently in the stock market. And that's the plan. You make money today, but you lose tomorrow, it doesn't matter, right? But what if you keep making money every single day? Then you can increase your size and make even more money. It's unlimited potential here, okay? If you know how to make money consistently in the stock market. Now, let me know if you have any questions. Again, my goal is to help you become consistent and be a confident trader who knows what he's doing. Okay, so if you have any questions, feel free to drop in the comment below. If you want me to make any other videos, let me know, and I'll definitely help you out. All right.